Good evening, friends. Happy to do the conference call today and share with you our thoughts on the bank and the our financial services business. First, on a big picture basis, two important thoughts on the overall situation, consistent with the fact that we have a very good micro, though a tougher macro. Our numbers reflect that reality, which is good micro, tougher macro. And number two, a belief that the formalization of the Indian economy in the financial sector is continuing to gain momentum. And in that context, our fundamental business model of concentrated India, diversified financial services is continuing to play well. With this background, just a few highlights before I hand over to my colleague Jaimin. On a consolidated basis, our profit after tax grew 27%. The bank standalone grew at 15% on a post-tax basis, but that is after a 82 crore hit on account of gratuity. As some of you may be aware, on 29th of March 2018, the Government of India changed the gratuity limit from 10 lakhs to 20 lakhs. As a result of which, there is a one-time hit of 82 crores, which we have taken on gratuity and fully provided in our books of accounts for the quarter ended March 2018. If that hit was not there, on a post-tax basis, the bank standalone profit would have been in excess of 20%. The loan growth at the bank has been about 25%. And if you look at the other points, which is the forbearance which RBI has provided, we have not taken any forbearance benefits into our financial numbers, whether it's on account of MTM or on account of provisioning for IBC cases. On the overall numbers with reference to credit and provisioning, there is our net NPA is now to below 1% at 0.98, and there is a steady declining in our provisioning costs year on year. Last year, the number was about 61 basis points on provisioning costs. This year, we are down to about 56 basis points. My view at this stage is I estimate this trending down on provisioning costs to continue, subject, of course, to no major upheaval in the bond markets, which are not within reasonable limits. On the stress itself, our SMA2 number now is probably amongst the lowest in Indian banking at 0.04% or 72 crores. This is consistent with a view which we've held and implemented over time of being conservative in recognition and also on provisioning. Another important fact which I wanted to discuss with you is on our low cost and stable liability. While, of course, our EOP numbers on SA and CA are pretty good, what is even more encouraging is our average CA and SA growth numbers. Therefore, for the January to March quarter, our average CA growth for the quarter, year on year, has been 25%, and SA growth is 58% YOY. We continue with our focus on building even further the low-cost and stable liability base. With that, I will want to talk about a significant increase in focus in terms of sharing information with investors, which we are doing with this quarter and for the year in three important segments. Number one is the life insurance business. As you are aware, life insurance business last year was a joint venture between Old Mutual and Kotak Mahindra Bank, with the bank's ownership 74% and Old Mutual's ownership 26%. We bought back the Old Mutual stake in October 2017, and since then, life insurance is now Kotak Life Insurance is now a 100% subsidiary of the bank. We are happy to report for the first time our Indian embedded value number for as of 31st March 2018, which is 5,824 crores. And as also our value of new business or VNB margin, as many of you analysts are familiar with, which is 29%. We have also shared, which my colleagues from life insurance will take you through, our product mix and other details. We believe we are building a strong, sustainable, and a high-quality life insurance business, which is something which gives us great pride. The second important area where we are making an important disclosure is in our wealth management business. And our wealth management and privy or the priority banking business, we are for the first time disclosing the relationship value of our customers in that business. And that relationship value number is 2,25,000 crores. We believe that we are market leaders in this, and we would continue to strive and improve our positioning in the wealth management business even further as we go forward. And lastly, in Kotak Securities, we have for the first time shared also our cash market share number, which is 8.5%. And of course, on the separate basis, our asset management business is also grown at 30%. Therefore, when I look at the combined picture, starting from loan growth, quality of our stress book, and the overall parameters in our core banking business to insurance, wealth management, securities, asset management, and the overall financial services franchise, I feel that there is a lot of momentum which we are seeing at this point of time. And on the customer numbers of the bank, which we have been sharing with you post last year, when we first announced 811, our customer base then was a little over 8 million customers. I'm now happy to inform you that as of March 2018, the customer base of the bank standalone has now crossed 13 million customers. Some of you may be aware that we had mentioned that we will aspire to double the customer base in 18 months, which is 16 million by September 18. And as of March 18, we have crossed the 13 million mark. With that, I will now hand over to Jaimin to take you through our results further.
Thanks, Uday. As Uday mentioned, for this quarter, we ended at a consolidated level a profit post-tax of 1,789 crores, 27% higher than the same period last year. For the year, we recorded a post-tax profit of 6,201 crores at the consol level, which is about 25.5% over the last year period. Big contributors to the post-tax profit this quarter, the bank contributed 1,124 crores. Kotak Prime delivered a profit of 160 crores for the quarter. Securities 134 crores. The life insurance business at 114 crores, and Kotak Mahindra Investments at 95 crores. In fact, each of these entities, the bank, Prime, Investment, Securities, and the life insurance company, for the year recorded the highest ever profit numbers. And as you're aware, we now own 100% of each of these entities. All the subsidiaries which are under us are now 100% owned by us. At the group level, we end the year with a CAPAD of 18.4% overall and a Tier 1 of 17.8%. Loan book at the group level at over 2 lakh crores now, and a net worth of over 50,000 crores. Book value now at just under 265 rupees per share. Overall advances at the bank have grown by 23% on a year-on-year basis.
25 in the bank.
And come to the bank, which is 25%. At the group level, our GNPA at 1.95% and the net NPA at 0.6%, with customer assets at 2,15,000. The bank has done a 25% growth on a year-on-year basis. We'll come to that when we talk about the bank. But before that, just request Murli to take us through Murli, who is the CEO of the life insurance company, to take us to the life insurance center.
Thank you, Jaimin. We are disclosing the Indian embedded value for the first time, and it is at 5,824 crores. Our VNB margin is 29.3%, and the value of new business is 522 crores. We have had a good growth of 27% on the new business premium, which has grown to 3,404 crores from 2,680 crores. We have had a good share of products. The mix has been pretty good. Our participating, non-participating products and ULIP are at 35, 29, and 36% respectively. Our renewal business has grown healthily at 32%, and our sum assured has grown by 25%. In our new business, the share of banker remains at 53%, while agency is at 47%. We have shown a good persistency growth this year and continue our growth in this area, and our 13-month persistency stands at a healthy 85%, and our 61st month persistency stands at 61.7%. Our total reserves now stands at 2,230 crores. Our profit after tax for the year is 413 crores. Our solvency ratio is at a healthy 3.05.
Thanks, Murli. Let me just take the bank standalone numbers. If I take the profit and loss account of the bank for the quarter and for the year, this quarter we recorded net interest income of 2,580 crores, which is about 19% higher than the same period last year. Other income for the quarter at 1,151 crores. Notably, the fee income, which is component of the other income, crossed the 1,000 mark for the first time. The fee income showed a growth of 33% on a year-on-year basis. The employee cost for this quarter, as Uday mentioned, took a hit on account of the change in the regulation relating to the Payment of Gratuity Act, and the entire hit of 82 crores which was there has been taken in this quarter. Other operating expenses for the year does include about 158 crores which was spent on items relating to 811. Number of other OPEX increases are linked to what we've seen as increase in income. On the investment provision, again, we have not taken any dispensation which the RBI permitted with respect to amortization of the MTM losses. So the entire MTM losses of Q3 and Q4 are things which we have taken the entire hit on for this year, this period itself. At a pre-tax level for the quarter, we have shown a growth of 19%. This is even after taking the hit on account of gratuity. At post-tax level, last year in quarter 4, we had some favorable orders which came in our favor on income tax, and as a result of which, the tax rate last year, fourth quarter, was much lower. And that's one reason you see the pre-tax difference year-on-year is significantly higher than the post-tax reason, the number. CAPAD at the bank at the end of the year, 18.2% overall and 17.6% at the Tier 1 level. GNPA at 2.22%, and net number now at below 1%, we are at 0.98%. Slippages during the quarter about 590 odd crores, about 1,800 crores for the year. And as Uday mentioned, SMA2 numbers at 72 crores being just 0.04% of the overall advances. On a segment basis, purely going by the RBI classification of retail and wholesale, where anything which is over 5 crores is in corporate and wholesale bank. The corporate wholesale bank recording a 784 crores profit for the quarter, whereas retail coming up with 500 for the quarter, and treasury BMU at 427 crores. The advances in the bank grew 25% on a year-on-year basis, and we've seen growth coming across board. The corporate bank grew at 25%. Commercial vehicle construction equipment doing a growth of 40% on a year-on-year basis. The agri division again doing a 21% growth. Home loans at 24%, and small loans Personal loans and credit cards, again, doing a 40+% growth on a year-on-year basis. Deposits, as Uday talked earlier, the CASA number crossing the 50% mark for the first time, and we are at 50.8%, without taking into account the sweep deposits, which are another 6.2% odd. And if we take averages on the basis of which we earn, current account average this quarter was the same period last year at a growth of 25%, and savings showing a growth of 58% on a year-on-year basis. CASA plus term deposits below 5 crores are now 77% of our deposit base. And at the balance sheet level, the bank's now having an overall balance sheet of just short of 2,65,000 crores. Uday talked earlier about wealth and priority. I just request Deepak to take that recognition.
Well, there's been a lot of debate on the size of our wealth business, and we've, like Uday mentioned, we've not disclosed this in the past. It's the first time we are disclosing the wealth number. We believe we are market leaders with RV of rupees 225,000 crores. This RV represents assets in banking, in mutual funds, in alternate assets, in depositories, all of that really. We basically follow an open architecture philosophy in this business, and hence we do end up being large distributors for a varied range of wealth products and services. We cater to practically the who's who of India, and like we mentioned there, we basically cater to practically 40% of India's top 100 families. We're seeing a lot of opportunity in continuing to grow this business. As India opens up, we see mergers, selling, and growing of businesses by promoters. The wealth management opportunity just is looking like growing a lot. This is largely a relationship-driven business, and historically it's been like that. But going forward, we are seeing a lot more of technology and digital come into play in the distribution and the servicing part of this business, and we are building up our business for meeting this requirement. I'll hand it over to Shanti to take on the digital piece.
Thank you, Deepak. Digital continues to be a way of life at Kotak, right from acquisition, engagement, servicing, and operations, aimed at better customer experience, higher productivity, and efficiency. Some of the key initiatives this quarter: biometric authentication, which is thumb or facial recognition for scan and pay transactions below 2,000 rupees. Instant online forex remittance portal for both customers and non-customers for the purposes of LRS, and the authentication is through Aadhaar. On our deposit side, we continue to get, in this quarter, 88% of the incremental volume on recurring deposits, 69 on fixed deposits came through the digital mode, and 32% of our incremental loans, salary, personal loans, came through digital. On the asset side, we continue our journey of increasing acquisition through digital in both cards as well as PL. And on home loans, we introduced for the salary class super fast home loans, which has really seen a significant increase. In Q4, we launched India's first bilingual voice bot, Kea, at our customer care center to help customers navigate quickly on their needs. Kea speaks both English and Hindi currently. We've also increased digital elements in our branches for customers, either for self-serve or assisted serve, including opening several e-lobbies for customer convenience. On the payments gateway, one noted point, we are amongst the top 3 banks in terms of digital payments, and this is as per information put out by the Ministry of Electronics and Information Technology in FY18. On 811, the acquisition continues to be strong. As Uday mentioned, our total customer base at the bank is greater than 13 million customers, and 90% of our customers are between 18 and 40. We offer free credit scores as well as 811, yeah, credit cards, And our engagement models, we have cross-sell across credit card, investment, insurance, and focus on better transaction experience on 811. In Kotak Securities, there's continued focus on increasing market share in digital trading volumes, and our cash market share in trading through mobile is actually from 17 to 20. In life insurance, 86% of the policies in Q4 were sold through the tablet called Genie, and 93% of the banca channels came through Genie. General insurance as well, digital is a way of life. I'll now hand it back to Jaimin to sort of take on.
Okay, let me take some of the subsidiaries there. Kotak Securities, again, the volumes have kept going up. This quarter, the average daily volumes at Kotak Securities at 15,839 crores, which is almost a 50% rise from the same period last year. We clock a post-tax profit for the quarter at 134 crores, and for the year, we're ending with 531 crores post-tax. And as Uday mentioned, our market share in the cash segment, where you really make brokerage money, is 8.5% for the year. At the investment bank, we have been in the middle of a number of transactions. We did the rights issue for Tata Steel, the IPOs for, among others, Bandhan Bank, and the QIP placement for HDFC. Number of transactions on the advisory side for Birlasoft, the buyback for Pidilite, working for the fairness opinion for IDFCs and Tatas. For the quarter, the investment bank recorded a 25 crores post-tax profit. For the year, 65 crores, of which almost all of it came in the second half of the year. The assets under management, we end the year with 1,82,000 crores, 29% growth on a year-on-year basis. Interestingly, at the domestic mutual fund, the equity fund under management grew by 71%, and we end the period with about 47,000 crores of equity assets under management. The asset management company and the trustee company of the domestic mutual fund recording 115 crore post-tax profit for the year. Kotak Prime, which is primarily into car finance, saw the asset book at close to 28,000 crores at the end of the year, having a very healthy net NPA number now at 0.37%, capital adequacy at 17.7%, and annualized ROA of 2.1. Kotak Mahindra Investments has a asset book of about 8,000 crores now. For the quarter, recording a profit post-tax of 95 crores, and for the year at 245 crores. Again, a healthy capital adequacy. We are at 19% cap ad at Kotak Mahindra Investments. So those are the broad highlights for this period. And if you notice, this quarter, almost a third of our profits have come from the non-bank entities. We would be open to questions coming in.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. Sir, before you start the Q&A, any further comments from you?
No, I think we'll open it up for Q&A.
Sure, sir. So, the first question is from the line of Mahrukh Adjani from IDFC. Please go ahead.
Congratulations. Could you share the ROE for the insurance business? And then I have a few more questions.
If you look at the traditional number, my net worth in the insurance company is about 2,300 odd crores. And as I said, we did a post-tax profit of 413 crores in the year.
Okay. And the other question I had is that do you have any plans of inorganic growth in the life insurance business?
We are always open to all opportunities, Maruk. Therefore, if you've got any bright ideas, you can certainly suggest to our team.
No, there are already some rumors, that's why I'm asking. Okay, and the third question I had is on the corporate loan book. So, and obviously you have seen corporate loan growth this quarter, but everyone's talking about huge opportunity and huge pie being shared by the state-owned banks. So in that light, do you think you can grow your corporate book much faster, or is it still risky? Because everyone talks about a big pie, but no one wants to take it up, right? Like even HDFC Bank did not grow sequentially very strong. So.
I'll ask my colleague Manian, who heads the Corporate Institutional and Investment Bank, to comment on this. Manian?
Yeah, you are right. There is opportunity to grow that book, and within our parameters of risk and return, if we can find the growth, right now we think we can grow at 20-25%. If we do find the markets favorable and the opportunity comes, we don't mind growing it faster as long as it meets our risk return parameters.
Okay, thank you.
Thank you. The next question is from the line of Sumit Kariwala from Morgan Stanley. Please go ahead. We'll move to the next question from the line of Manish Karwa from Deutsche Bank. Please go ahead.
Yeah, hi, congratulations. So I just had a question on the 811 and the customers that we are accruing now. What is the nature of these customers, and how easy is it to raise balances there, and what are the cross-sell opportunities that we are looking at? And also to supplement this, in this digital backdrop, how do we see the branch rollout, and what do we see as cost-income ratios going forward?
Manish, first of all, on 811, roughly the cost of customer acquisition is about 80% lower. Okay, 80. Against that, of course, balances are lower than what we get from normal. Okay, and one of the reasons for that lower balances also comes because it's a completely different age profile that we are getting. And for us, this is a great way of diversification of our customer segments, and it goes back to our history essentially being a mass affluent and higher kind of a bank with not being able to have a model which gave us the ability to penetrate the broader consumer segment. With this, and combined with the fact that even in normal branch banking, we are now able to do biometric, we are now able to have an ability to build a cost-to-serve efficient model in the mass banking business. So as we become broader, our aspiration goes up, our ability to serve a much broader and a larger customer base in India is now significantly possible. Yes, we are fully aware that the front-end acquisition cost, even at 20% of normal cost, is going to hit our front-end P&L. But that's the price we are ready to pay for what we think is building a sustainable business in addition to the mass affluent segment into the mass segment. And we actually believe that this is something which will change the way banking gets done in India in the years to come. And we will continue striving on that with a higher front-end cost, which comes as a result of significantly larger customer acquisition than the past. And this is something which we are also working on a number of areas of cross-sell, which is obviously we are making some success on debit cards, on getting customers into branches, which are unbundled charge for specific transactions. We're getting entry into credit cards. Therefore, Manish, some of this is philosophic. We believe this is a game changer, and we are continuing to commit to it. It's similar to the kind of conviction we've had on the whole area of savings account deposits, when many of our competitors took a call last July, August to actually cut down their savings deposit rates. We held on conceptually because we believe that we need to keep on getting a lot more sticky customers to build a sustainable, low-cost, stable franchise, because that's what will serve us over the years. And today, with the change in interest rates scenario, we believe our call is right. Yes, Does it cost us a P&L on the savings account of nearly 1,000 or 1,200 or more than 1,200 crores now in a year? Yes. But when you're building a business for sustainability, this is the price we have to pay and build the business and the franchise. And in that context, on branches, we will now open, most of our integration is done. Therefore, the rationalization of branches, cutting through different common branches, all that is now significantly behind us. And our phygital strategy, which is physical plus digital together, is now beginning to play. Therefore, we actually need branches to be able to serve even digitally better. Therefore, we are going back to a point where we will add more branches, maybe about, give or take, around 100 a year, to places which gives us a greater penetration in the physical and digital world combined. And therefore, we are not shying away from investing, whether it is through 811 or branches, as long as we believe our fundamental philosophy of sustainable, low-cost and stable liability franchise is worked. And we are beginning to see a lot more cross-sell success across the board, including on assets, which is a part of the reason why we are getting loan growth, including in the retail segments. So we feel the synergies are working. Customers flowing in is much better. We are ready to take the upfront costs of it, whether it is in terms of 811 and other acquisition cost of customers at now 5 million customers, new customers a year on a base of last year's 8 million, which is a 60% growth in customer base. We are ready to spend more on savings account because that gives us faster growth. Our SAR growth average is 58% year on year last quarter. So we are truly excited and not scared of investing.
No, sure. Your customer acquisition has been phenomenal. Like 60% increase in the last 6-7 months is great. And cost to income ratio, do we continue to expect to decline as we move forward, despite the investments that you are making?
Manish, therefore, we are right now, if you look at for the quarter, around mid-40s, okay?
Yeah.
We obviously are, we got the synergies out of the merger a little late, which whether it was demon, whether it was technology, whether a whole host of reasons. Therefore, the synergy benefits of the mergers have started literally in 17, 18 and more towards the second half. So we continue to see synergy benefits for flowing further out of the integration in the next year. And that benefit will continue. At the same time, we will continue to invest. Now, where does this combined box bring our cost to income? We will see. But at this stage, I don't want to be short-sighted in our investment philosophy. Therefore, I would say currently, give or take around the mid-40s is where we think we should currently assume where we are. And if we improve, we get greater productivity, good. But not at the cost of under-investing in our future.
Perfect. Thanks so much, Uday.
Thank you. The next question is from the line of Mayank Bukhariwala from Goldman Sachs. Please go ahead.
Yeah, hi. This is Rahul here. So, of course, great earnings, across the parameters, we've seen the improvement. Now, I have 2-3 questions. Number one, on the lending growth. So it's really heartening to see that, we're getting convinced about the environment. Now, if you were to kind of, take or maybe just try to understand the visibility of this growth that you have, do you think, your confidence is there for the next few quarters, or only in this quarter we have seen and hence we've grown?
Rahul, once upon a time, you may be aware we were joint venture partners with Goldman.
Correct.
And this is when Goldman was a partnership firm in the 90s. So one of the messages I used to get from Goldman partners was under promise and over deliver.
Yeah.
Okay, so when we gave out guidance to you last year, we said we would like to see around 20%, then we changed it to 20% plus in the second half. And we are happy to report better than that to you. So in the same spirit for next year, I will guide at 20% plus. But I'm not saying we will do necessarily over-deliver, but this is where we are.
Got it. Now, within, the various loan products, across the board we've seen improvement, but business banking continues to remain a bit subdued. So, when do you see this piece particularly turn around?
Okay, I think Narayan, will you want to talk about business banking? But just divide, if you look at the segments, if you look at small businesses, working capital, personal loans and business loans, that has grown at 40%. The SME piece, which we call as business banking, by design, sort of, it's all based on risk assessment and risk-adjusted returns in a GST world. But Narayan, you may want to talk.
Yeah, thank you. First to explain, the business banking has borrowers where the lending will be upwards of 10 crores of rupees. In this segment, while it did get majorly affected post-demon, started recovering, and then the GST came in. They were adjusting for GST, which took some time for them. At the same time, we became cautious because we were not sure how major all these businesses across various segments, especially in the SME space, are going to adjust themselves. Post that, we see that the large and formal players are growing and capturing market share in their respective spaces. We have started increasing the acquisition now. So to summarize, yes, we have not grown in this segment, but to some extent was conscious, and also we were waiting for the GST to settle and post that start our growth engine.
Is it possible to get some sense in terms of the disbursal growth in business banking, because the period end balances might be getting impacted by the repayments also, right?
That's correct. And I think, Rahul, what has also happened is fundamentally in the whole SME space, there was a fair number of players which were essentially on some sort of tax arbitrage.
Yeah.
So their whole model was based on the formal sector, larger players paying taxes and indirect taxes fully, and then there was a model which was the informal economy model in this segment. That part of the model is actually got seriously affected. And I have said this, I think the soft underbelly in many banks which may not have, let me revert. The soft underbelly of the stress in this space may not be fully out and fully represented overall in banking. And it's something which we saw it coming about 18 to 24 months when we were doing the ING Vaishya merger with us. And ING Vaishya, as you know, had a significant SME book. So when we merged the two, we got a lot more insights into the issues around this business. And therefore, on a combined basis, and I'm not saying book A or book B, on a combined basis, we did a very thorough sort of analysis and screening of the book. And now we feel actually far more confident that we are getting a much better handle on risk-adjusted returns in this segment. And therefore, it's like we are always very open to slowing down any particular vertical where we feel the risks are something which are not commensurate with returns. And once we feel comfortable, we're ready to ride the engine back. And I'll give you an example. If you go back in 2012, we had significantly slowed down construction equipment, which went through a very rough pace post 2012-13. And about 2 years ago, we rekindled that engine. And now we are growing that business at 40%.
Correct. Just one last question, if I may. Is it possible to get a broad mix of small business, personal loan and credit card portfolio within these three categories?
Maybe Jaimin offline if you can just look at it, but there's a lot of stuff, Rahul, there's so much of segmentation we can do. Finally, from the point of view of even analysts, you got a lot to cover. Don't complicate your Excel sheet too much.
Yeah. No problems. Thank you so much.
Thank you. The next question is from the line of Adarsh Parasrampuria from Nomura Securities. Please go ahead.
Yeah, I had a couple of questions on the life business. One, the margins that you all have indicated, I believe that's post overruns. Is that the correct understanding?
Yes, it's correct.
Okay. And the second question I wanted to ask was on the protection side. You all mentioned as a percentage of total premiums, it's about 22%. What I wanted to understand is on an AP basis or on a weighted basis, what's your protection mix?
We have mentioned the 22%.
Yeah. Oh.
On an APE basis, it's 7%.
It's 7%. So just again, putting the things in perspective, your non-par product share is like 29%, and that's on an APE basis. Of that, 7% will be protection, and the rest of it, will be non-par savings. Is that the
29%? Okay. The 29% which is referred here is relating to individual products. And the 7% which I told you is on the AP basis of the entire business.
Okay. Understood. So overall, your protection mix is about 7%. Perfect. And another question relating to the banking business. You just mentioned about the 150 crore that you would have spent on 811. I believe that would be some form of recurring, or it's more like as you grow and you get more customers, then it's more fixed cost model. So this you will kind of not keep incurring your 20-25% growth on this number over a longer period.
Obviously, I mean, we believe that our customer acquisition engine will continue to grow to a certain extent. At the same time, the base which we have acquired will start giving us returns in terms of our revenue lines on that. So, and there is no dramatic, our incremental operating cost of 811 customers is very low. The acquisition cost will continue for new customers, but as our base grows, the revenue comes on the entire base, no?
Correct, yeah. Understood. No, perfect. This is helpful. Thanks a lot.
Thank you. The next question is from the line of Nishan Shah from Macquarie. Please go ahead.
Hi, sir. Congratulations on the great set of numbers. First question is on life insurance. Sorry if I may have missed this. Were the operating ROEVs declared for life insurance? Has someone already asked this? I may have missed it.
We've just initiated this year, so going forward, we will start giving you operating ROEs as well.
Okay, sure. Fair enough. And secondly, on this 811 account, it would be really helpful if you can, show some productivity metrics on this. Like, say, a gradient of, how many, what percentage of accounts have what kind of balance. Like, these are lot of, new young customers. So how many of them would be, say, maintaining, say, at least 5,000 rupees of balance or something, or any other, productivity metrics, like what is the cross-sell ratio here, or something that we can track and see, the efficiency of this new customer acquisition engine?
See, keep in mind, we always have to balance between more and more sunshine versus making sure that we also want to keep our competitive edge.
Okay. Great. Okay, fair enough. Thank you. That's it from me. Okay.
Thank you. The next question is from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah, congratulations. Good set of numbers. My question is with respect to the deposit mix. So phenomenal job being done on the savings. But if you look at the retail term deposits, in fact, the growth has been almost like 10, 11 odd %. So currently, maybe in the interest rate scenario wherein we are, plus say more than 20% balance sheet growth, how do we overall see the maybe the outlook on the retail term deposit? Some of the banks have been very aggressive this quarter, and we have seen significant rise. But what would be our view given we are more than now 50% CASA?
So I will take that question. Last year, actually, two things happened. One, you saw the reduction in the rates at the beginning of the year when the interest rate cycle started dropping. And at the same time, you saw also, thanks to that, the fund flow starting into alternate investments like mutual funds, etc. So in the term deposit funds, you really had to fight the battle between various, of the customer, of allocation between term deposits, investments, and other alternate investments. So while our drive continued to remain, we saw some amount of monies actually flow out through us itself into other alternate investments. I think from January this year, again, we've seen a turn in the cycle. We've seen rates starting to get better, and, across the industry, deposit rates have gone up. And again, we are beginning to see a better accretion actually in Q4 of term deposit rates. So I think it is a function of rates, and it's a function of, investment allocation of customers. We have no choice but to make sure that we focus on and keep growing our term deposits. As Uday mentioned, our low-cost, stable deposits, the retail deposits, particularly below 1 crore, is a very important focus area and will continue to be so.
But hasn't the overall term deposits in Q4 been lower as compared to that of Q3? Because if I just look at the numbers, it suggests that there has been a sequential decline as such rather than the accretion.
No, let me just take that overall number. No, not exactly. If you look at the That's coming purely from the fact that the certificate of deposit number, which is primarily interbank, that has gone down. If you look at the non-CD number, that's actually done fine.
Okay. And as you highlighted at the start, financialization of savings is the key interesting trend. But still, when we look at it, even in FY18, the contribution of banking business to the overall profitability has been, say, 75%. So do we see maybe the non-banking businesses going up significantly? A trend was there in Q4, but is it more sustainable? And out of the non-banking businesses, which would be more growth-oriented, be it in terms of either the asset management piece or maybe in terms of the capital markets? What's your view out there?
See, you want to divide this into three parts. One is what you call as more sort of stable, less cyclical businesses, which is what banking core deposit and lending franchise of the banking business is. And then there is a piece which is, again, more annuity, which is like life insurance and some part of the asset management business. And the third part of it is what you call as more cyclical, which is capital markets, whether it's securities and investment banking. Layer all this with levels of risk we take in each of these segments. Therefore, our key view is how do we get, while we are completely open to growing risk businesses for returns we make, we are also very focused on making sure what percentage of our total revenues come at lower or no risks from a credit or a financial point of view. Of course, there's a reputational risk in everything we do, but therefore the whole mindset of the firm is for the levels of risk-taking, what are the returns we are making? And that is the DNA which drives us as we sort of build our businesses. We are always a little more careful to come back and tell you that we are taking disproportionate risks because we want to grow our earnings. We would like to grow our earnings where our risks are commensurate with our returns. And overall, are there a set of annuity businesses, whether it's wealth management, asset management, or other agency businesses, which continue to give us a high profitability at much lower credit or financial risks, while we continue to take credit risks on the core banking business. Therefore, coming to an answer is more about returns for the risk we take and for the franchise which starts producing returns without commensurate financial risk.
Okay. And lastly, in terms of the data points, what's been the other income in the Kotak Mahindra investments? It's quite significant, 75 crores.
Okay. One particular investment gain which we've had, so we booked some capital gains during this period, so that has been one spiky thing which has happened this quarter in KMI.
And quantum?
About 40 odd crores.
Okay. Yeah. Thank you.
That's pre-tax, huh?
Pre-tax.
Thank you. The next question is from the line of Ashish Sharma from Enam Asset Management. Please go ahead.
Yeah, thanks for the opportunity. Most of my question has been answered. Just one on the ROA and ROE for the bank. We are at 1.7% ROA for FY18 and we are a little off from the ROA we had before the ING merger. What sort of a time frame do we see in terms of reaching to the pre-merger ROA of closer to 1.9%? And what will be the levers for the same? And do we see also an increase in the leverage because we remain a little overcapitalized? Just this one bit on ROA and ROE, sir.
Look, it's like, yeah, if you look at 173, if you're looking at pre-merger, we would have been at about 1.85, 1.9 thereabouts. So we are improving there. There was a time when we had gone as low post-merger at to 1.3, 1.4. So we've steadily improved from there at 1.76 for this quarter. We are getting that improvement. So it will have to come from both revenue improvements and the costs. We've worked on both of that and we're seeing improvements there. This quarter, as you're aware, we've taken some provisioning hits also. So to that extent, this number we're talking about is after all of those. ROE, yes, the fact that there is a higher capital, tier 1 particularly, which is pure equity, does drag my ROE. And if I was therefore looking at the ROE number on a normalized capital at the bank standalone itself, it would be about 16 odd. So to that extent, and at the console level, decently 18 and a half thereabouts. So yes, to that extent, we will need to kind of sweat a little more.
Yeah, and I think you've also got to keep in mind, we continue to pay 6% on savings. We continue to make big investments in customer acquisition. All those are continuing investments we are making.
Okay.
Therefore, to that extent, we have to think about this as a growth business, which is how we think about it, rather than a mature business.
Okay, perfect. I think this lastly, haven't heard much about how we want to leverage this stress asset management opportunity. We have been talking, this is a very big opportunity. I think when we had raised capital, we had mentioned some bit that we would use that as capital, but we haven't understood exactly what is the structure for the same.
First of all, I'm sure you would have read in the media about us having made a bid for Jaiprakash Associates along with our fund partners, where we obviously would put some capital on this along with it. Therefore, we are obviously working on this area, continuing to put money to work where it makes sense. But the whole area of IBC, as you know, is currently in an evolutionary process. And therefore, this first foray into Jaiprakash Associates bid, which you would have seen, comes as a partnership with a few other players, including a sovereign, where we put some capital to work along with partners. So we are not shy of making it work. What we are also seeing is the whole IBC process is evolving. There are a number of projects we are working on as we talk to you, and I'll ask my colleague Deepak, who's driving it, to take you through some more color.
Hi. Like Uday mentioned, the opportunities in the segment are numerous, but they are evolving like the laws in the segment. And in the beginning, the way we've really looked at it is let us not jump fully into it. Let us just get our feet experimenting where the bite sizes and the structuring is, come from a risk-return point of view. So we, along with, appropriate partners, are testing the waters in some of these segments. So once we see first 12 and maybe the next, 40 odd come closer to, closure, which probably will happen over the next 2 to 3 months, some form or the other. I think we'll be far more clearer about the legalities involved, issues involved, what works, what doesn't work, what is appropriate, what is not appropriate. And I think by this first round, most of the strategics will really be out of the picture, really. And then we have a very, very long tail, that's really balanced on of stressed assets. And I think we will really have a lot to play in the remaining long tail, and that's what we're really getting.
Perfect, sir. Perfect. That will be all. Thank you, and all the best for the next year, sir. Thanks a lot.
Thank you. The next question is from the line of Harshit Toshniwal from Jefferies. Please go ahead.
Hi, sir. Good evening. A couple of questions. So starting with the life insurance business, currently the VNB margins for FY18, as you reported, is somewhere around 29. Can you give a color of how has this evolved over, say, last 5 to 10 years? Basically the cycle, what it was the bottom of the cycle, and how has it evolved over the period?
I'll ask Gaurang to answer a very evolved question.
And a long-term question. I think over the years we have always focused on a risk premium, and we were one of the first one to ride the bus. We started as early as maybe in 2004 and 5, and we always have gone for a extremely balanced product mix, and that is right from beginning between, say, ULIP on traditional participating, non-participating, overall on a group or an individual business. And one good thing we always had a bank which is the promoter bank, which helped us in terms of keeping that balance. We also invested in agency. All these things combined together, we have been able to maintain relatively higher margin all throughout.
Okay. And if I look at your business mix over the period of time, the unique part about your model is that group business for you has been around 40 to 50% since last 7 to 8 years. So as you said that in the presentation, the mixes of the individual APE, based on individual APE, within the group, can you help us explain that what kind of products are we more concentrated into? Credit Protect must be a good part of it. And apart from that also?
Yeah, I think we do all the three protection. Number one is credit term, then we do the employer-employee group, and we do the individual term. So I think in terms of profitability, as you know, the best would be credit term, individual term, and then rest will be employer-employee. So I think we focus on all three.
Any broad mix which is there currently of all these three within group?
I think the largest would be a credit term, and employer-employee is a steady but low-margin business. And in terms of individual, we believe we need to improve on where we are because there is a lot of scope and a lot of focus which is going on. But there also we have been growing consistently.
Okay. And sir, so most of this group Credit Protect would have been done from Kotak also. So any other banker partnerships which we have apart from Kotak Bank?
Maybe we just about started disclosing information. So leave some questions for time.
Okay. And just last data point question. So number of employees at a bank level, if you can disclose that.
Overall about 50,000. Bank would be about 35.
35,000 bank and overall 50. Okay, sir. Thanks a lot. Yeah.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal Securities Limited. Please go ahead.
Hello.
Yeah.
So my question is on the credit cost. Now that we have seen sequential improvements in asset quality and the SMA2 number is like unbelievably good this time. So what is the outlook on credit cost? Is there any change to it that we can expect?
Yeah, as I mentioned at the beginning, our view is that overall credit costs continue to trend down. Therefore, in the absence of a big economic shock, our view is credit costs will continue to trend down.
Right. Okay. Thanks so much, sir.
Thank you. The next question is from the line of Manish Shukla from Citigroup. Please go ahead.
Good evening and thank you for the opportunity. If you look at the loan mix, unsecured loans for you are growing at around 45%. And we kind of see the same trend across the banking system where personal loan credit cards are going in excess of 35-40%. What is driving this? What is the confidence which is getting? Because obviously the underlying income at the individual levels are not necessarily rising at this pace.
Yeah, I think a very good question. Let me first say that in addition to our unsecured, if you look at our construction equipment and commercial vehicles, that is also growing at 40%. So, and this is a view. First of all, our unsecured base is a much smaller base compared to some of the cases where you may be. Yeah.
If I look at across the group, our unsecured number would be about just over 20%, 21 thereabouts. In the bank would be slight marginally higher.
So this is very small, relatively small percentage of our total mix. Having said that, the base is smaller and we at this stage feel one of the things which we really care about as we look at our credit, this thing is we don't like excessive concentration on any single segment disproportionately. Therefore, you will not find us to be at 60% or 70% unsecured personal or unsecured as a part of our total loan book. So that's what I would just want to highlight to you. Therefore, mix, risk-adjusted returns, focus on avoiding concentration disproportionately to any segment like microfinance or unsecured loans or credit cards. And we look at margins not in absolute terms but on a risk-adjusted basis. And we understand the very significant difference between the margins of an unsecured book versus a secured book.
Okay. All right. My second question is your thoughts on how the February circular impacts the banking system. I know it's not much relevant for you, but the thoughts on the broader system impact for the...
No, I think it's not just February circular. It's something which some of you analysts almost thought about me to be like an old broken record who kept on saying there is stress in the system since 2012, but it almost sounded like a broken record for a few years. The fact of the matter is overall stress in the system, we can debate, and this is purely judgmental. My sense is certainly more than 20% of the loan book of the banking industry. And so far, whether that number would be close to around 16 lakh crores. What is disclosed so far is give or take 12 lakh crores, stress plus NPA put together. So we have some way to go, and there's some which has also been sitting on banks' balance sheets on off-balance sheet. So off-balance sheet exposures were taken by banks sometime in 2011, 12, 13 with 5 and 6 year tenors. Some of them are also beginning to bite. And frankly, I still think there is some more recognition to go and certainly a lot more provisioning to go.
Just that bunching of these cases, do you see that this pushes up LGDs across the system?
Yeah, because when you have got disproportionate supply in a short funnel, it is bound to have an impact. And therefore, again, we can debate, but I don't see total recovery on loans exceeding 40%, probably lower. That means the loss ratio is going to be in excess of 60%. And we are not even, I don't think, again, the banks, I don't understand this, but when I'm looking at pricing of stress, I'm looking at present values. If I get a repayment of a loan where I take a 10-year zero-interest debenture and show it as a regular asset in my book, the present value of that is pathetic. So I have to price the stress at present value, and I don't think that is still fully priced in.
Sure, sir. Excellent. Thank you. Thank you very much.
Thank you. The next question is from the line of Rakesh Kumar from Elara Capital. Please go ahead.
Thank you. So I just wanted to get your opinion on this IBC matter, because since it started, now we have 700 or perhaps more cases, including the cases referred by the RBI. Now, so apart from this, the number of cases here and, a couple of frauds which are already NPA are coming on surface. So the abilities of large corporate and the promoter-driven companies to operate is even lower now. So what would be the impact of these two events, which have, started, taking place now of late and last some months on the second layer of businesses, mean to say the MSME segment going ahead?
Yeah, I think I believe that the intent of IBC process is good, which is cleansing the system. But when you do the cleansing in a very narrow funnel, there is a risk of some purge. And there could be high frictional costs of that, which is what we are going through right now. For us to be able to give you a better view, probably it's about a year from now. Venkatu, my colleague, is here, who's our expert on managing distressed assets. So I'm going to ask Venkatu your sense on this IBC process and the stress in the system, and how do you see it play out?
It's still very early days, and every day we see different kind of judgments coming across from various courts. The entire process is evolving, and every judgment is getting overthrown in some other courts, and understanding at various levels are also found wanting. So it's a new law, it is evolving, it is taking time, but as a process it has got a lot of good. If it really works out well, it could clean the system, but in my view it will at least take 3 to 4 years for it to settle down.
So much?
Yeah, it is.
I think it's faster, but that's an internal difference in view.
No, the number of cases we have is too many.
Yeah, okay.
And what could be the impact, of these resolutions on the relatively smaller companies like SME and all?
I think the problem is if there is only one bidder or zero bidders, that's where the challenges will come. And over time, I think there may be a need for the policymakers to think about this promoter not bidding and the impact cost of that in total loss given default, finally. So I think it's a fast evolving thing. I understand the moral hazard of huge haircuts being taken by banks and promoters getting the companies back cheap. That is one part of the story. But there's other part of the story. Finally, how much is the hit the system will take because of this huge pressure and lack of enough buyers for all the assets.
Thanks. Many thanks. Thanks a lot.
Thank you. The next question is from the line of Roshan Chutki from ICICI Asset Management. Please go ahead.
Yeah. Thank you so much, sir. Yes, most of my questions have been answered. Just one question. VNB margins, you have discussed at an aggregate level. If you can provide the VNB margin.
You're not clearly audible.
Is it better now?
Yes, thank you.
Yeah. So, if you can disclose the VNB margins at the product level, how much is it for par, non-par, and ULIP?
Baba, the child has just started walking. This is the first time we have disclosed it. You guys are well ahead because you have been covering other public listed companies. So, give us some time because of the nature of consolidated entity. We will over time try and see how we can get investors and analysts access to the individual businesses separately. So I've been telling my IR team to think about sunshine days where we can think about that at some point of time. But let's see how it goes. But this is a first important start, and over time we'll see how we can improve disclosures even further.
Sure, sir. Thank you so much.
Thank you. The next question is from the line of Sanjay Parekh from Reliance Mutual Fund. Please go ahead.
Yeah, thank you. Congrats to the whole team for a great set of numbers. Udai, one question on this, recovery in micro and macro deteriorating a bit. With such large size of problem, do you think if it gets delayed, it can actually also impact the delay in recovery of micro?
Yeah, but what is happening is capacity utilization in many sectors has gone up now. So for what was 65 to 70% capacity, that is going up because, you just look at steel. There is a huge pricing power which has come into steel industry. You ask auto companies, they have to wait in queue to get steel.
Right.
So if pricing power comes in, if capacity utilization goes up, then for guys who are in business and who are not having any issues, they will continue to get more and more share. And I think overall across sectors, you're beginning to see some sort of consolidation into a fewer hands, whether it is steel, now whether it's telecom. So you're beginning to see that trend also develop,
Right. Thank you.
Thank you. The next question is from the line of Ritesh Bhattacharya from Asian Market Securities. Please go ahead.
Hi. Thank you, sir. Just one question. In your asset management business, last year we grew 71% in the equity AUM side. So how much is the SIP contributed for?
Gaurang, you don't have the answer straight away, but I can tell you our SIP has become...
It's a very, very important component.
And we have had a very high focus on SIP. As you know, Nilesh Shah, who runs that, is very passionate about SIP. And they have lots of things like SIP day, this day, that day. He's a great believer in SIP. Absolutely.
Okay. Thanks. That's all. Thank you, sir.
Thank you. The next question is from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Yes, sir. Most of my question answered. I have only one question. In terms of some media reports suggesting that big acquisition for Kotak Mahindra Bank and private banking side. So one is not a question of the acquisition confirmation, but in terms of managing the large corporate balance sheet or managing the infrastructure side of the business, how open we are for that thing?
Hello. First of all, I just don't want to comment on any rumors or speculation or anything like that. If there was anything we had to share with you, we would have shared with you. There is nothing for us to, at this stage, be there to be able to share with you your concerns about what the future may or may not be. So if ever there is a situation like that, I'm sure my management team will think about all those risks before we do anything stupid. Rest assured on that.
Sure, sir. Thank you very much.
Thank you. The next question is from the line of Ojasvi Kecha from SBI Cap Securities. Please go ahead.
Yes.
Your line is unmuted. Please proceed with your questions. Okay, so there's no response. I would now like to hand the conference over to Mr. Uday Kotak for closing comments.
Okay, thank you very much. Really appreciate the interest and response which we have got on this review. It really matters to us as you cover us and sort of communicate with the entire investor base and investors who are on this call. We will continue to do our best and stick to really continuing to build a strong financial services franchise. And at this stage, we are quite confident of the continuing growth trajectory despite some of the macro challenges which will continue to play out. Thank you very much, ladies and gentlemen.